Assalamualaikum warahmatullahi wabarakatuh. My name is Noah Shikin binti Muhammad Rosli. My metric number is 1222443. Today I will be presenting the budgeting calculation for Smart Industrial Gas Corporation. We will go through the schedule of expected cash collection, merchandise purchase budget, and cash budget for November and December. Let's begin. Schedule of expected cash collection. Let's start with the expect cash collection. The company collects 75% of sale revenue in the some months and 25% in the following months. November collection calculation. From November sales, 75% of 340,000 ringgit equal 255,000 ringgit. From October sales, 25% of 320,000 ringgit equals 80,000 ringgit. Total collection of November, 255,000 plus 80,000 equal 335,000 ringgit. For December collection calculation, from December sales, 75% of 360,000 ringgit equal 270,000 ringgit. From November sales, 25% of 340,000 ringgit equal 85,000 ringgit. The total collection of December, 270,000 plus 85,000 equal 355,000 ringgit. Now that we have calculated cash collection, let's move on to the merchandise purchase budget. Merchandise purchases budget. To determine purchases, we use this formula: cost of goods sold for the month plus desired ending inventory minus beginning inventory. November purchases calculation: cost of goods sold for November, 71% of 340,000 ringgit equal 241,400 ringgit. Desired ending inventory for November, 75% of December cost of goods sold. December cost of goods sold is 71% of 360,000 ringgit, which equal to 155,600 ringgit. 75% of this amount is 191,700 ringgit beginning inventory from October, 181,050 ringgit. For December purchases calculation, cost of goods sold for December, 71% of 360,000 ringgit equal 255,600 ringgit. Desired annual inventory of December, 55% of January cost of goods sold. January cost of goods sold is 75% of 350,000 ringgit, which equal 248,500 ringgit. 500 ringgit. 75% of this amount is 186,375 ringgit beginning inventory from November, 191,700 ringgit. Purchases are this equal 250,275 ringgit.
Okay, now we are going to discuss the question 1D. The question is prepare budgeted income statement for the November and December. So here is my calculation for the budgeted income statement. As you can see, it a little bit different compared to November and December. And the total net income for the November is 56,000, and for the December is 61,000. The net income, we can get the net income by by subtracting no by minus the gross profit and the total of operating expenses. Uh, the total of operating expenses, cash expenses plus the depreciation. Okay, like that. Okay, for the question 1E, budgeted balance sheet for the end of the December. The cash at the end of December is calculated by adding the cash balance from the November cash collection in December and deducting cash payment for merchandise and expenses. Account receivable represent the 25% of the December sales that will be collected in January as per the company's collection policy. The merchandise inventory is determined by the calculating 75% of January cost of goods sold as the company desire to maintain this level of inventory. The PPE, property, plants and equipment, the net, remains unchanged as there were no new purchases or disposal during the November and December. The account payable then reflects the amount owed for the December's merchandise purchases as payment are made the following month. Retained earnings are updated by adding the net income from November and December to the opening balance from October. And the lastly is the total asset must equal the total liabilities and equity, ensuring the balance sheet balance as required in accounting, as it reinforces the balancing nature of the financial statement.
Okay, my name is Nurul Najah bint Azli and my metric number is 1222442. Answer for the question 2 is A, direct laborers rate variance. Each actual rate minus standard rate multiplied by actual hours work. And to calculate the variance, which is 2,000 multiplied by 7 ringgit plus 1,400 multiplied by 7 ringgit and 20 cent minus 3,400 multiplied by 7 ringgit, and it will get 280 ringgit, which is unfavorable. And for B, for direct labor efficiency variance is actual hours work minus standard hours allowed multiplied by standard rate. And for, for standard hour allowed and 800 multiplied by 4, it will get 3,200 hours. And to calculate the variance, 3,400 ringgit minus and 3,200 ringgit multiplied by 7, it will get 1,400 ringgit, which is unfavorable. And for C is direct material price variance is actual price minus standard price multiplied by actual quantity purchased. And for iron to calculate the variance is 2 ringgit minus 2 ringgit multiplied by 5,000, it will get 0. But for chopper variance is 3 ringgit and 10 cent minus 3 ringgit multiplied by 2,200 ringgit, it will get 220 ringgit, which is unfavorable. And for the direct material quantity variance is actual quantity used minus standard quantity allowed multiplied by standard price. And for iron is standard quantity allowed 800 multiplied by 5, it will get 4,000 pieces. And to get the variance is 3,900 minus 4,000 multiplied by 2, it will get 200, which is unfavorable. Meanwhile, the chopper standard quantity allowed is 800 multiplied by 3, it will get 2,400 pieces. And to calculate the variance is 2,000 minus 2,400 multiplied by 3, it will get 600, which is unfavorable.
My name Nurul Natasha binti Mahmud. My metric number 1222441. I want to explain how to calculate overhead expenditure variance changes. The formula of OEV is actual overhead minus budgeted overhead for actual hours worked. For variable overhead, budgeted variable overhead is 3,400 multiply RM 3.00 is equal RM 10,200. OEV for variable is 12,000 minus 10,200 equal RM 1,800, which is unfavorable. For fixed overhead, budgeted fixed overhead is 3,400 multiply RM 2.00 equal RM 6,800. OEV for fixed equal 800, 8,800 minus 6,800 equal RM 2,000, which is unfavorable. So total OEV 1,800 plus RM 2,000 is equal RM 3,800, which is unfavorable. For overhead efficiency variance changes, the formula OEV, standard rate, multiply standard hours for actual output minus actual hours work. For variable overhead, 3.00 multiply 3,200 minus 3,400 equal 3.00 multiply 200 equal RM 600, which is unfavorable. For fixed overhead, OEV for fixed 2.00 multiply 3,200 minus 3,400 equal 2.00 multiply 200 equal RM 400, which is unfavorable. So total OEV RM 600 plus RM 400 equal RM 1,000, which is unfavorable. Next, to calculate budget variance expenditure for fixed overhead, the formula is actual fixed overhead minus budgeted fixed overhead, which is 8,800 for actual fixed overhead minus 4,000 multiply 2.00 for budgeted fixed overhead, which is 8,800 minus 8,000 budgeted fixed overhead equal RM 800, which is unfavorable. For volume variance on fixed overhead, the formula volume variance, which is fixed overhead rate multiply standard hours for actual output minus budgeted hours, which is 2.00 for fixed overhead rate, and then standard hours for actual output 3,200 minus budgeted hours 4,000, which is 2.00 fixed overhead rate multiply standard hours for actual output minus budgeted hours, which is 800, which is equal RM 1,600, 1,600, which is unfavorable.